Welcome to the February 2022 Market Diary, also which is going to double as the 1 year recap. So we started this project beginning of March of 2023, and I kind of want to take a look back at both what happened in February and what happened over the past year. So let's start first off with February and what's happened since then. So first of all, Walmart had a stock split. In that stock split, it went from 3 to 1, so I went from 54 shares to 162 shares with an average purchase price of 146 down to 49 per share. And you can see this here is how it got calculated out. I had whatever I had, they multiplied by 3 essentially, or multiplied by 2 essentially, and that's your 3 to 1. So yeah, Walmart did that, and as you can tell, it's been going up fairly regularly over the past year or so. I've been very happy with Walmart. It's everything about its earnings calls have been great. Everything about its technical analysis has been great. Its PE, its dividend. Walmart is the best thing I've ever invested in, and I'm very happy that I chose to go in when I went in. It's a solid company, and it's one of the few that I've never had a doubt in my mind about owning. So it's the one that's caused me the least amount of anxiety. Now, if we go on a buying spree that I did have in February, I bought Microsoft, Amazon, and ARC. Now, I did say this at the end of the last market diary that I wanted to buy Amazon and Microsoft at like a 9-to-1 ratio. I pretty much did that. As you can tell, I bought 22 shares of Amazon at 167 a share. I bought 3 shares of Microsoft at 403 a share, and because this was just dividends and money that I already had in here, and I just wanted to round out all of the money I had $20 left over, so I bought 1 share at $20 from ARC. ARC is another one of those companies where I've never felt bad about owning it because it's essentially like buying a 10% bond. The company drops 90-ish% of their total revenue into their dividend. So long as they're still making money on their loans, we will still continue to pay out at that 10% rate. And so far, I've been very, very happy with ARC and parking my money there. Amazon and Microsoft, you can see my little panic in July, where I sold all my old stake in them. I've regretted that ever since, and I've been trying to buy it back, and I've been buying them back at inflated prices to where I did buy them literally 50% off from where I bought them. So that's unfortunate, but we are slowly starting to rebuild a position there, and it will be my goal in the next year to fund these 2 stocks first. Anyways, it's good to go over the final numbers 1 year later. We are currently at a portfolio value of about $62,500 with a dividend yield of about 4.5%. We have put in the trades themselves that we have bought into have cost about $58,500 if you take the price per share and the number of shares I have. So on paper, it only looks like I made about $4,000, but as we go through the history and what I've put in versus what's come out, a lot of that is reinvestment of gains from either selling or dividends. So there's a lot more than just that 4,000 there as far as what we've made over the year. And the final results are probably going to surprise you, but this fell in line with my overall strategy for the year, in which case we wanted to get our dividends per quarter up to, a decent amount. And in my opinion, $600 every 3 months, that is an extra, that's like an extra week's pay. Like, how can you be mad at like making your money work for you so that you have 53 paychecks instead of 52? This is why I enjoy dividend investing, because it gives you, even if it's taxed, it gives you a tangible look back and saying, hey, I'm actually seeing return on my money that's real, and I can use it to buy more shares to make my overall portfolio look better. Now, it's also true with straight shares alone. Like if we look up here at Microsoft, it's up, a decent amount. Same here with Amazon. Like they've made a lot more than I've put into them. And that's great. That's numbers on a paper, but there's something about getting a dividend payout that makes you think like, I actually own this company. I'll give a slight anecdote. Walmart pays about $33.70 a quarter ish. I went to Walmart about a month ago, not even, and I decided I wanted to buy a beef stew. The ingredients of that beef stew cost exactly the amount of my dividend payment, so Walmart bought me beef stew. Like, that kind of tangible X equals Y is what makes investing for me feel more real than just like an online video game slot machine simulator. Because when I started investing, I started with the option slot machine. I played the Tesla lottery. I did very good with it. I played a lot of SPAC lotteries with options. I did some very risky things with money I didn't really have to lose. And it taught me a lot. It got me to actually go to get my master's in finance so I could learn what I was actually doing. And that pain was worth all the life lessons that got me to the point where I am okay with seeing this, 1 to 3% every month and thinking that is good enough. And trying to break out of that mindset of anything less than 100% gains is a loss was very, very hard. So I am very happy with the slow and steady growth in this very risk-weighted return that I am seeing. So it's little things like that that have made this more than just an Excel printout to me. And I'm very, very happy with the current distribution right here that we see the capital percentage of our portfolio and the stock percentage of our portfolio. Now, this one's always going to be weighted differently because clearly you're not going to have 600 shares of Microsoft. The price is $20 versus $500. Even though they have the same amount of money put into them, it's still, it's still not going to be equal as far as shares go. But that equal weight of how much money I've put into them, I do want to get that closer to making all of these closer to about 17, 18% each, which is why I'm trying to get all of these up to $10,000. So February 29th numbers, you can see that everything is green except for Enbridge, which is still red by about $600, and that's fine. You're always going to have some losers. Not everything you do is going to be a winner. So long as more winners than losers, we're good. Now, let's look at the full year in review because I've kind of been alluding to what's happened. First thing is running total gains. Now, this red line is the percentage of gains month over month, and this is the total amount of extra money versus what I put in at that time. So if I only put in $1,000, but my portfolio value was $3,000, you'd see, $2,000 here. But if I've put in $50,000 and my total amount was $60,000, you'll see, $10,000 right here. So this is taking the total sum of everything I've put in, subtracted by what my total account value was at the end of the month. And that's how we get the total running gains. So it is taking a look at the whole and not just month to month, because the month to month you'll see looks very different from this. Whereas I was constantly seeing my money go up over time, you did see some massive pullbacks, like these 2-month periods here, this 3-month period here. And the last 4 months have just been 3 very good months in a row, which have seen decent returns. So overall, the trend line is up, but imagine being in these 3 months, which, by the way, 1 is not January, that is March, and 12 is also March. So back off 3 months. So this isn't, this 8 is actually the 5th month, so this is May. Sorry, reverse that. This is December. Or November. 8 is November. I can math. Trying to do this live is so great. 8 plus 3, so 11. Good job, Oberst. You can do basic addition. But yeah, so this is November. So we had a pullback right before Christmas, and then Christmas came, and then the first 3 months of the new year, and it's been great. Quarter 1 of 24 has been great. for pretty much everyone. But if you look at my month-over-month variance, you can see that, like, yeah, November and August were bad. July was bad. Like, there were months where it was just... Sorry, this is August. This is August. So, like, there are months where it's like you're really struggling, and you have to, like, just realize that just because you had a bad month doesn't mean your overall trend is bad. And while we always joke that the market always goes up in the long run, it's hard in the moment to be able to live through the ups and downs. And if you go back and watch, like, my previous market diaries, like, these are some of the best thumbnails I ever had because I could put giant, massive red minuses there. And they, did better than ones where I didn't show massive losses or massive gains. Like, so yeah, like, view-wise, it was great, but personally speaking, it was hard to keep invested, and it was hard to be like, no, this is a good time to be buying the dip and putting more money in and all the rest. And while I was in these downward slumps is when I went into VU. Like, I went into VU at the worst possible time in the market, which is the only reason why VU did as well as it did. So if we take my full year in review here, you can see my total running gains. Like, we went down, like, significantly at times, but the last 3 months brought us up to, like, that almost 15%, almost $10,000, like, total return. You can see how much I've put in, like, as the year went on. So, like, we started this off with about $30,000. That was both February and March of that first year. That's how much we started with. And then as the year went on, we put, a couple $1,000s in. Not consistently, like, none of this is consistent. It's just, as I had stuff to put in, I just put in the most amount I could. I think I drained my bank account like 5 or 6 times over the year. Just because I was interested in building up the portfolio in the bad months. You can see that, like, the bad months, I put in most of my money during, like, the bad times, because I understood that I was buying the dip, and no matter how much this hurt, no matter how much, like, my total running gains were coming back, my original thesis was the worst is over, we're going to get better, let's keep zooming. Remember, there's a banking crisis in here. There was a pre-AI, like, we're going to have a hard landing issue. Like, there were a lot of problems that just were going on throughout the year, and it was hard to be an investor in 2023. Not as hard as it was in 22, and not as hard as it was in 21, but it was just hard to go through all of that negative news cycle and macro issues and rate cuts this and bank failure that, and just there was nothing good that was happening unless you were in the tech sector and you were, like, playing that AI bull wave. And clearly I got worried in here because this is where like I sold Microsoft and Amazon, because I just could not get behind the revenue story for AI, and I just was like, I was having flashbacks to the 90s and being like, nope, this is another bubble, it's going to come crashing down, it's overvalued, don't buy into it. And it was really hard to finally look at the numbers and go, there's actually a burger here, this isn't a nothing burger, like, there is actual revenue cases here. And once you put that finance hat on, it made it a lot easier to go, no, this is the right time to go in, these are the right companies to go into, and just do it. Now, in doing this video, I wanted to back test VU and Chill, because one of the things that I learned over the year was that looking at an ETF that tracks the S&P 500 is a good benchmark to figure out, are you doing well or are you doing bad? Now, when I started the year, I only wanted 8 to 9%. I only wanted a 4% dividend and an 8 to 9% return on the values of the stock. And that goal alone massively undershot what the S&P did over the past rolling 12 months. Now, how do I show that? This is if I had put the same amount of money in that I had, and bought shares of VU as the money that I put into the market anyways. I bought at the average price of the open of the previous month, the close of the previous month and the open of the following month. So I took the average of those two. So it's the halfway point between day 1 and day 31. Now, as you can see, VU, like March, April, May, June, July, like they had a good bump here. But then August, September, like these were bad months. And then it just started to take off. So VU would have been very, very hard to start with when this was the return that I was going to be looking at. Like living through this would have been an emotional roller coaster. Wouldn't have made very good videos either because, I'm in a one account thing and VU and chill isn't very interesting to make videos about. But it does tell you like what you should have expected if you were just following the market. Now, this is what my active portfolio versus what VU did. So if you take, let me try to lean to the left so you can see this. So like it goes down to $4,000 on the minus side and up to 5,000. So this is the variance of what I made in a month versus what VU would have made me in a month. And as you can tell, like that first month, like I did better than owning the ETF. Then we were negative. And then, these 2 months we did a lot better. This was the AI boom when Amazon and Microsoft took off, and I thought we were about to see multiple contraction. And I panic sold. That's why you see like these like massive gains here, because these are panic sells of my 2 best performing stocks. And then this is also where I get into VU. So like a good 1/7 of my portfolio is now tied to this thing that I'm back testing. So now I'm working with 93% being active. And you can see that like from here on out, I did worse than the overall market because the overall market is being driven by essentially 7 stocks that I don't have a heavy investment in. I'm trying to build back that investment so I can track closer to this. But as of right now, I am getting the conservative returns that I set out initially and moving the goalpost back to looking to the S&P 500 or a index fund that tracks the S&P 500. You can tell that I was doing well until I sold the things that caused the market to be driven forward. Now there are several things that I can say about the market consolidating into, 5 or 6 like singular stocks. But if you want the returns of the market at the time, then you have to go into those things that are driving the momentum. Now, long term, could that pose risks? Yeah, everyone piled into all of the .coms. Like, look at, I think it was Cisco when the internet was first getting started, and because Cisco was selling the routers that connected you to the internet, it's no different than NVIDIA selling the GPUs that are going to AI. Eventually, everyone's going to have a GPU for their capital planning, and they won't need to buy the products. It's like iPhone sales when they first came out versus today. People are now just replacing iPhones as they break rather than having to buy their first iPhone, so there's massive adoption. Like, there are risks like that I'm looking at that I'm going, this is going to hurt the market in 2 to 3 years. It's not going to hurt now, and if I'm not going to invest now, I'm going to miss out on the ride and being able to pull out before that, capital expenditure dries up. But I'm also going to limit my downside risk when that bubble does pop by hedging my bets away from just those 7 overvalued companies. Now, I'll still have Amazon, who, I made this joke with my friends last night. Google allows you to sell user data. Amazon allows you to visit the websites that allows Google to sell your data. Microsoft allows you to own the system that allows Amazon to visit the system that allows Google to sell your data. So like all of these mega tech companies all are a walled garden within a walled garden that require each other in order to push the next company's revenue. Amazon owns like 1/3 of the back-end systems that allow the internet to run. They are the Cloudflare service provider that just allows you to go to websites. Like Amazon Web Services, everyone thinks of Amazon as a delivery company. It's an internet company that happens to sell groceries. Like they're a long way from their bookstore days, and Amazon Web Services is literally their main primary revenue driver. Microsoft, likewise, used to just sell operating systems, but they have so many different revenue streams now, including the AI, which is driving their current revenue story. But like all of these tech companies require each other in order to grow, which is why being on the second and third order part of the drivers, I'm more okay with. I see Microsoft and Amazon having more sustainable revenue levels than I see Nvidia with their current record-breaking revenue, because that revenue will dry up once all of these corporations buy the base technology they need to do the calculations they need. And once that's done, you're going to see innovation where they can now vertically integrate, where Nvidia is going to get cut out of the picture. So you only need to sell shovels once, unfortunately. Shovels don't tend to break, and once people know how to make the shovels, they'll make better shovels that are more suited to their needs. So yes, I'm watching Nvidia, I'm kind of having FOMO, but I'm also looking at Microsoft and Amazon going, they're not as risky as what I might see in some other tech stocks. So I'm okay with going into them more. I'm okay with buying into VU, which is heavily weighted towards those two companies. So this is a long way of saying that I will be very heavy in tech in 2024 because those are the ones I'm going to build my position in this year. Am I probably 12 months too late? Yeah, I should have done this in 2023 when they were massively on sale. Amazon's revenue looked awful around here. Like, I shouldn't be in the company. The company had an awful revenue story. That has changed over time. Microsoft likewise had some very iffy revenue stories right up until the AI boom. And then they had a whole new revenue source that was actually monetizable. So anyways, that's a long way to say that if I had VU'd and chilled, I would have made about $3,000 more than me being an active manager right now. If we look right here, it was a 20% return for VU and chill, and it was a 15% return for me actively managing. Now, there was a point in September where VU would have only been up $850 from the money that we would have put in. So like of this 46,000, it would I would have put in 45,000 of that. So like there was a point where like this total year-to-date return was not great. And then you get over to me where I was 10% up and I'm looking like I'm the smartest guy in the room. I'm really not. I just happen to have sold two very good tech things and I've reinvested into things that gave me a decent return in these months. Like that is the only reason why these year-to-date gains went up. But then as the market kind of consolidated around the Christmas time and the holiday season, which was better than expected, plus the takeoff from there, you can see that their revenue exploded. And finally in January, they had a very good month. And this was the time where my deficit compared to what I made versus what they made was huge, like real account value wise, because this is just comparing the VU account value versus my account value. Like that deficit is huge, and the overall gains started to pull away here until finally you get to the point where we're at the end of February, where if I had just bought into the ETF, I would have made $3,000 more. I would not have learned half of what I learned on this journey, but I would have made more money. So my education in active management and figuring out which stocks to pick and why I'm picking this and looking at all the quarterly reports and learning about these companies and learning why X has something on Y, or why VU is even a good investment to begin with and why that ETF works, all of that cost me about $3,000 in education and life lessons and opportunity cost. And I view that as an educational experience. Anytime I lose money in the market or lose money in opportunity cost or FOMO or whatever, I view that as a cost of, it's a life lesson cost. It's a cost of learning. I'm not paying a teacher to teach me these things. I'm paying the market as a whole to teach me these lessons, and so I can learn and move on and grow as a person. And that's why we backtest, by the way, so that we have something that we can peg ourselves to see if we're doing good in the grand scheme of things, and also gives you some solid goalposts as that won't always continue to move. Now, this wasn't my goals when I set out last March, But as the year has moved on and I've learned more, this is slowly becoming my goals. So speaking of goals, here's the scorecard for the year. So we put in about $53,000 over the last year. At the end, my value of my actual account was about 62.5. In February, we made about $1,500, which was about 2.5%. Now, Voo and Chill would have made $66,000. So my end of year gains was $9,000, which was 14%, which is nothing to laugh at. 14% is more than I could have gotten in any bank account just sitting on cash, doing nothing. 14% is a huge amount of money to have made in a 1 year period. And that is almost 10 grand of money that we earned by risking it in the market and learning and going through all of this emotional turmoil. And it taught me a lot, and it is good to look and see, hey, we did something meaningful here. Now, does it hurt when I look at what my back test was if I had just done nothing and just done like the most basic investment advice of having a one fund portfolio of like VOO or VTI or any of these Vanguard funds that have no maintenance cost and just have a long track history of like doing very, very well? It hurts, but it showed me that going into VOO, once I have a baseline of 10 grand in every single column that I want to do, is not going to hurt me, and it can only supplement whatever I'm doing on the active side. And that's what this has taught me. Now, I want to go through my rules of engagement in 2023. First of all, my thesis was that the market had bottomed out in March of 23. We called that correctly. The market had bottomed out. We wanted to find companies whose products I used. I use Amazon because I use the website, use the internet. I use Walmart because that's where I shop for groceries. That's where I shop for clothes. I shop with Walmart. Microsoft, clearly I'm on a computer right now and I have a mouse. I have left click, I have PowerPoint. Clearly I'm using Microsoft products here. So we're using Microsoft stuff. Exxon, I use plastic products. I use oil and gas products. Exxon is so much more than just the gas you put in the pump. So I do use their products. Enbridge, anyone who uses natural gas, if you have a stove that uses natural gas, Enbridge supplies the pipelines that gets the gas to you. They go from Canada to us, and they supply the heat for the northern states, and they have pipelines throughout the country, both America and Canada, and I use gas, so I use Enbridge. And ARC is the only one that I don't use because I am not a mid-tier business that requires a loan. But they did have what I needed in order to get my dividend level up to that 4.5%. So I view them more as a bond, which is it's a bad way to look at it, but I view them more as a bond than I view them as a company that I've invested in as expecting shareholder returns. I'm expecting essentially a bond payment every 3 months. And that's how I'm viewing it. It's a very bad way to view that company, but it's how I've justified owning it, even though I don't use their services. Now, finding companies on sale. Anytime you see this green X, it means that I kind of halfway went there. I found companies that were on sale. Unfortunately, I sold 2 of my best performing ones that were on sale, and I had to rebuy them at prices that were definitely not on sale, which is why I consider this a half success, because I bought in to the 2 tech funds at highly inflated prices, and I lost out on probably about $3,000 to $5,000. We have reinvested all the dividends that I have ever made back into my account. I have never taken a withdrawal of dividends at any point since I've started this. So every single time I got dividends, they went right back into the portfolio, buying more shares throughout my actual portfolio. So we did stick to this. And planning to hold to 3 to 5 years again. I'm going to bring up Microsoft and Amazon because while I didn't sell anything else this year, I did sell those 2, and it was the biggest mistake in hindsight. At the time, it was not a mistake, but in hindsight, it was just because of things that I didn't know at the time, and things that I did know at the time showed me that some things should have gone a very different direction. I reevaluated and I eventually came back to them, but it took time and it took about a quarter or two for me to realize, no, I made a mistake. Let's go back in. Now let's look at our goals. We did get dividends to 3.5%. We actually got them to 4.5%. We are in 4 industries right now, plus an ETF, so I'll consider that 5. We have a fairly equal weight portfolio, but we're trying to get that up to 10 grand. And right now it's kind of misweighted because of decisions I made in the very beginning of H2 of last year. We do have a good mixture of growth, value, cyclical, consumer. So we do have a good mix of different kinds of companies, and we returned 14%. So we exceeded that 7 to 9% that I initially thought of myself as being like, this is a hard goal to hit. We well exceeded that, which allowed me to pull the goalpost back to like hitting the market returns of VU. Like the fact that I'm more than doubling, the fact that my goal was half of what VU returned and I made it somewhere in the middle, that makes me very, very happy. Now, rules. We broke this one because assuming a dividend growth model of 0% is asinine, because every single company or most companies that had dividends, they've gone through their 4 quarters with the same dividend, and now they're starting to either add to it or they've in some way caused that value to go up. Either they did share buybacks or did something. So most companies have grown their dividend in some way. I did not dollar cost average quarterly. I threw money in as I got it, and I usually just went in with whichever one allowed me to get the most amount of shares. And I did not dollar cost average. I was making active trades to decide where I put my money instead of trying to do it in a more blind and regimented way. In order for dollar cost averaging to actually work, you need to put in like $100 on the same day of every month. And that takes away the risk of buying too high or selling too high, or buying too low or selling. It takes away the risk. And I didn't do that. I was putting money in as I thought things were well valued. And yeah, I didn't follow this rule. I'm continuing to feed my portfolio well and beyond getting the 3.5 dividend achieved, because I realized that the market is actually good for providing real tangible wealth and real tangible, it has improved my quality of life. So I have continued to feed my portfolio because for me, I realize investing is actually a good way to make sure that I am in a good spot financially for my age and quality of life. So I have continued to feed it, and I will continue to feed it. So I broke that rule. We did use all of our dividends to reinvest, but we didn't only use our dividends to reinvest, which is why I consider this a half fail. And I'm going to break this again, but long-term capital gains only requires you to hold stocks for more than a year. And very clearly, I did not follow that. I did all this stuff down here miscellaneous, as far as like why I wanted to do certain things. Like all of these were very, very helpful for me getting started, and it gave me a good grounding position. Now, I've changed my rules of engagement for 2024. Let's start with the thesis. I think this is the beginning of a boom market. I think we're 2 years out from the AI bubble bursting, and I think that we have a lot of room to just kind of zoom forward for the next 2 years before we see a major retraction. I want to fund the companies I own to $10,000 each. That is a personal goal of mine. It's going to require that I somehow put in about $12,000. Yeah, about $12,000 this year in order to do that. I want to continue reinvesting all my dividends, which is another $2,000 on top of that. So in total, I want to fund the account about $12,000 to $14,000 this year, and I do not want to panic sell. Like that is my current thesis for the year 2024, is put more money in and get to a good spot where I don't feel the need to constantly add or check or move or reallocate. I want to get to a point where everything is equal weight, and then we see what happens. Now, goals. I want to get to that $70,000 capital base. I am close, but I'm currently way over indexed in ARC and Exxon. I do want to maintain at least a four and a quarter quarterly dividend. And the reason why is because I'm at 4.5 right now, but if I keep buying Amazon and Microsoft, that percentage is going to come down because that's how, dividend yields over total account value works. I do want to have my overall portfolio exceed VU returns, and I do want to average at least $1,000 a month. Now, this is a stretch goal. I want to have my account hit $100,000 by the end of March of 2025. That is incredibly unlikely because that would require 30% returns. I don't think I'm going to hit that. I'm probably going to get close to 88 to 90, and I will be very happy with that. But that is probably where I'm going to end up. But my stretch goal is 100K. Now, here are the risks. I've alluded to this earlier in the video, but we are in the risk of being in 1998, where the music is slowing down, but everyone is still at the party and drinking and don't realize that the guest is trying to get us to leave. I think we could be there. If inflation kicks back up after Fed's lower rates, that could send a black swan event throughout the markets in a very similar vein as to what happened in the 1970s. And that was very much a lost decade for both investing and just general quality of life. So I am very, very nervous about the Fed making the same mistakes that happened in the 1970s. Oil stocks do have geopolitical risk, and I am noticing more and more and louder risks with that. And, I have a decent stake in 2 oil and gas stocks. Tech stocks are at questionable multiples. I have beaten this horse dead multiple times. Pun not intended. But yeah, their revenue to multiple level, because that's the two-way stock prices move. Either revenues go up or future earnings potential goes up, one of the two. And I think that the future earnings potential is higher than it should be, but it's not so high that it's not uninvestable. And again, ARC is a business development company and a loan company, and their existence is just inherently risky because of how the company is set up to begin with. I think they are a solid company and they aren't going anywhere, but keep in the back of my mind that they could go belly up at any given time because it is a loan company. Loans go bad, things go bad. And the way that they're structured, Ares Capital is a private equity firm that owns ARC, which is Ares Capital Management. So it's a larger company that owns a smaller company that can cut ties with that smaller company without harming the host company that's above it. So there is a risk there. Now, rules. I'm going to fund in this order: Amazon, Microsoft, and Enbridge. Now, that doesn't mean I'm just going to fill Amazon to 10,000, then Microsoft 10,000, then Enbridge 10,000. I mean that I am going to heavily weight towards Amazon with a little bit of Microsoft in there and Enbridge, just to fill in the gaps of, like, if I have $200 to invest and Amazon's 170, I'll buy a share of Enbridge for 30. Like, that's what I mean by fund in that order. Now, I can sell 30 shares of Exxon at 120. Why can I do that? Because if we look at my purchase history of Exxon, you'll see that I bought 50 shares over a year ago at 110, and that is the highest price point I have ever bought Exxon at. I also bought 30 shares a little over 2 months ago at $99. So because I'm at $13,000 for Exxon, and I want to back that off to $10,000, selling those 30 shares will drop my overall average purchase price by a decent amount by getting rid of some of the highest value shares that I have bought, and then moving those to either the Amazon, Microsoft, or Enbridge to kind of re-level my account and rebalance it. And that will be long-term gains only, which follows the last rule on here. Anyways, I am going to reinvest all of my dividends into Microsoft, VU, and Walmart because those ones are closer to that $10,000 goal, and with making about $600, that allows me to buy one share of Microsoft and then one share of Microsoft or VU, and then I can buy the rest with Walmart as it's now under $100. So that's where that goes. And I do not want to sell any other shares this year other than those 30 shares of Exxon. I want to buy and hold. I want to see if I can have the self-control in order to do that. Now, here's some miscellaneous things that might seem interesting that I've already touched on. Why 4.3%? Because it accounts for the yield dilution from me buying all of these non-dividend or lower yielding dividend stocks. Why match VU? Because VU is a good proxy for the S&P, and it gives me a good benchmark that isn't as as arbitrary as what I did last year. Why sell 30 shares of Exxon? Because I want to get down from 13 to 10, and I already showed you how that works with what I've already bought. Why 12K of an annual funding goal? Because it's achievable for my savings rate and for my income, and obviously my needs are not your needs, and your needs will vary, and what you're able to do will vary. So don't take, because I'm saying I want to do this, that you have to do this or that you should do this. This is just a very personal thing to me, because personal finance is very personal. And while I am doing this out in the public sphere, I also don't want to make anyone feel like this is what they should do because this is what, I'm doing, and you feel like you have to copy me. Don't copy me. Just understand why I'm doing something and do things to your comfort level. Will I do any options gambling this year? I'm putting this in more as a joke, but I have to constantly keep myself from YOLOing NVIDIA calls, as I keep seeing it going up and up. So I'm going to say no, but I also know that I have no self-control and that options gambling is fun. So if I do that, it will not be on this account, and it will be with money that I know I can lose. So you will never see me make a video about it. You'll never know if I do or don't do it. But if you all of a sudden see a large amount of money come into this account one day, that's probably where I got it from. So, I don't plan on YOLOing options, but if I do, I'm not going to talk about it. And two, I'm not going to advise you do it, because it is very much gambling. It's not trading. It's not investing. It is just straight gambling. It's calling heads or tails and seeing which way the, stock's going to go. So don't do it. Learn from me, but I also have no self-control. Anyways, here are my general disclaimers and warnings. Please read it. Please take all the yellow highlights to heart and everything else that is there. And I thank you very much for staying along for this very, very long year-end recap, because this is almost a 42-minute video. So I do appreciate you sticking around with me for this long. And while this is probably going to be our last market diary, because I don't plan on doing this going forward, I do plan on bringing more financial content in the future. And in what form that brings, I don't know yet. But there will be less monthly videos on what my portfolio is doing. And there's probably going to be more just general finance and general things where it's not as personal to me, because I don't want to make this an actively traded account, and I want to allow myself the flexibility to just do nothing and not feel like I need to do something to make a video out of it. So in order to reach those goals, I'll pull back on the market diary videos, and I'll probably do a little bit more finance and revenue-based videos going forward. So thank you very much for taking this journey with me for the last year, and I hope that it was helpful and that you were able to see my own growth in the last year and see some of the pitfalls and learnings, so that the expensive mistakes that I made, you don't have to repeat. You can learn from me. So thank you very much for watching. I will see you guys all in the future, and whatever way our plans may take. So thank you very much, and I will see you all soon. Bye.